Diversify the smart way. In this episode, we're going to address the question, what are indexing options in IUL, and can you change those options as you go? So get ready. You're going to be blown away with the flexibility behind an indexed universal life insurance policy. So I'm Doug Andrew, and I've been doing this for more than 45 years. What's this? Helping people optimize their assets, minimize taxes, and not outlive their retirement. In other words, redefining their retirement years by not following the herd, by keeping their money in traditional IRAs and 401ks, taking the required minimum distribution, thinking they're saving tax. And so there's a lot of strategies that subscribers to this channel learn by getting answers to questions that, frankly, a lot of the financial services industry professionals don't even know the answers. And so in this particular episode, I'm going to talk about indexing options. And don't be surprised if you've not heard about this, because there are many financial advisors that immediately think I'm talking about indexed mutual funds. No, I'm talking about indexing as a strategy. Let me briefly explain. My favorite vehicle is a max-funded IUL, Indexed Universal Life Insurance Contract. And so in that, since 1980, that's where I have put my serious cash, and I've earned average rates of returns of 8.2% up until 1997. What happened in 1997? That's when indexing came out. And when I saw that, it was a no-brainer, and my average return went from 8.2% up to over 10%. Now, how does indexing work? You're having your money linked to the market, not in the market. See, I don't want my money at risk in the market. So let's say I have $1 million. It doesn't matter if you have 10,000, $500,000, $1 million, 10 million. Okay, we have clients that have tens of millions of dollars in their max-funded IUL. So they use it for working capital for business, for retirement, income, and so forth. And we know that one client in particular has $8 million in his IUL, and it generates $800,000 a year of tax-free income at a net of 10% payout without depleting principal. So how does that work? If I have $1 million of cash value inside my IUL right now, and I want to just hunker down and play it safe because I think we're headed for a recession or something, I can just settle for the insurance company's general account portfolio rate. So in the 1980s to 1990s, that was usually 11.75% to 15%. Now, the last 20, 25 years, we've been at an interest rate low. So many insurance companies on AAA and AA bonds and mortgages on shopping malls and skyscrapers have only been earning like 5 or 6%. So if their general account portfolio is, let's say 6, like it was from 2000 to 2010, it was a little bit north of 6, they need one of those percentage points for their profits, but that means I would net 5%. So on my million, I can choose to just hunker down and accept the 5%. 5% on $1 million is $50,000. I can take it out. It's tax-free if I take it out. If I leave it there, it compounds tax-free. If you don't know why, be sure and click on other episodes to learn why. Now, if I feel bullish about America, in any year, like an election year, where many times politicians, it doesn't matter Republican or Democrat, they will make the economy look vibrant, dynamic, and growing to get reelected. So during election years, I usually link my returns to an index or indices of my choice. And that way, I do not put my million at risk. My million must stay safe in the insurance company earning 5%. What I'm doing is I'm giving up the for sure 5%. I'm telling the insurance company, don't you dare risk my million. That must stay safe. I want that no matter what happens in the economy or the market. But you can take the $50,000, the 5% interest you're earning on my money. I'm willing to give up the 5% interest and let you use that however you want, so you'll have the wherewithal to pay me whatever the growth on these indices is. Now, the most common indices are the S&P 500, the Dow Jones, maybe the Russell 2000. It could be the Euro Stock Index, or in Japan, is that the Hang Seng, or the BUDB, the Barclays U.S. Dynamic Balance Index. So many times I will diversify the smart way. So for example, in 2010 back to 2000, that 10-year period, worst 10-year period since the Great Depression, I could have taken that million and had 20%, 200,000 linked to the Dow. I could have had 200,000 linked to the S&P, 200,000 to the Russell 2000, 200,000 to the Budbee. I could have had the remaining 200,000 just sitting there earning 5%. Now, during that time period, just doing that, walking away, I would have earned 7.23%. But every year, I can change the indices that I am linked to. So when people say, well, which one do you use? Well, sometimes I might have more of it in the S&P, sometimes in the Budbee. And by diversifying, then I have that type of rate of return where some years I have earned 16% with one, 12% on another. If I have some of my money just in the general account portfolio, that's 5%. But people, by diversifying, by linking to different indices, they have averaged in excess of 10%, many years even 11, 16%. Like 2017, many of our clients earned 16%, as high as 25%. So let me talk about the linking period next. So there are linking periods. The most common is the 1 year point to point. So for example, in 2011, what was it? An election year. President Obama was running for his second term, and I knew my chances were better than not that the economy would be growing during that time period, but I wanted to protect myself in case something out of his control, like a terrorist attack, would cause a dip or a crash in the market. So I used indexing. So I linked. Now, by doing that, I chose November 15th as the linking date that year to November 15th of the next year, 2012, right after the elections, okay? And sure enough, I locked in gains of 16% that year. Even though the market went up a little bit higher than that, I was capped at 16. Why? Because the insurance company doesn't have my whole million to put in the market. They only have the interest on my million to buy upside options. So if the market did crash, the options expire worthless, but I didn't lose my million, okay? The options just expired, and so at least I didn't lose if the market went down. But if it went up, the insurance company had the wherewithal with $50,000 of options to pay me 3 times that. 15, 16%. They're big boys and girls. They know what they're doing. People say, how can they afford to do that? No, they can afford because they're buying upside options. Because they do not have to keep the $50,000 on hand in case the market goes down. You've relinquished that interest, but not your principal. Does that make sense? So the linking dates can be year point to point. You can also have 12 linking dates. That's called dollar cost averaging. We have people that put in 100,000 and that 100,000 is linked, a 12th of it is linked January to January the next year. A 12th of it is February to February, March to March, April to April. That's called dollar cost averaging, so that you're not worried about just a 1 year point to point like I did in 2011 because I knew it was the election cycle. And so you can do dollar cost averaging, you can do 1 year point to point, 2 year. Another popular one that many people choose is a 5 year. You're linking on a date, and 5 years later, whatever the market is at, because it's usually up, you will get that entire gain with no cap. Or there may be a cap of 100 or 200%, but people have made a tremendous average rate of return with a 5 year linking, especially after a crash. You link right at the bottom of a crash, and 5 years later, sure enough, you're going to probably make a killing. So those are linking dates. Linking methods are next. So let me explain why there's caps and the different linking methods that you can use to enhance and diversify with your money. So linking methods also allow you to diversify. For example, one of the simplest ways is to simply say, okay, I want you to link to, let's say, the S&P 500, and they will measure 1 year point to point. And during that period, if the market goes up, they will pay you whatever the S&P does. If the S&P goes up 10%, they'll pay you 10%. If it goes up 15%, they'll pay you 15% if the cap is that or higher. But if the cap's only at 12, the most they will pay you is 12% if that's the cap. But see, if the market goes down, you don't lose. You don't earn anything, but see, in that case, zero, earning zero is hero. because you didn't lose. See, in 2008, a lot of our clients were actually cheering when everybody else in America that had their money in the market, they were panicking. And our clients were going, go, go, because they weren't losing. Most Americans lost 40%. A million went down to 600,000. Our clients still had their million. The next year, the very first 90 days, they locked in gains of 16% after not losing a penny. Most people took 4 years to make back what they lost. And so sometimes zero is your hero. Many times people don't like zero. And so there's trade-offs. You can say, well, I want 2%. An insurance company may say, well, we'll pay you 2% on $1 million. That's 20,000, which is double what banks maybe were paying at the time. And so they'll pay you 2%, but the cap comes down from maybe 15 down to 13%, or from 13 down to 11. If you have a little bit higher floor, then the ceiling comes down. And those have averaged between 8 to 9% for the last 40 years based on actual stock market history. Sometimes you keep the floor down at zero, but you have a lower cap because the insurance company will say, we'll pay you 140% of whatever the S&P does. What? How can they afford to do that? Well, in this case, if the general account portfolio rate is 5%, my million would then be earning 50,000, and I'm saying you can have the whole 50,000. You don't have to guarantee me 2% or anything. You could have the full 50,000, but I'm willing to accept a cap of only 13 instead of 15, because if the S&P only goes up 10 or 11, you'll pay me 1.4 times that. You'll pay me 140% of whatever the S&P does. That is used during the markets that go up and down like a yo-yo. The most common question I get asked is, so Doug, which one do you use? My answer, all of them. See, I diversify the smart way. See, I don't define diversification as having my eggs in a basket where some of these eggs are getting broken because the returns are pathetic or it's not in a safe place. Why would I do that? I want to diversify in superior investments that are tax-free. I diversify by having indexed universal life insurance policies with this company, this company, this company, this company. Some on me, some on my wife, some on my kids. Some with this index, some with this one, some with 5 of them. I diversify back and forth, some with this linking method, some with a 5-year linking method. I am so diversified. I'm more diversified than most financial advisors ever diversify their clients' money. But see, what did I do by using these different linking methods? From 2000 to 2015, not only did I accomplish this, but many of our clients did the same thing. $1 million in the year 2000 doubled to $2 million by 2007, the end of 2007. By the end of 2015, it doubled again, and it was $4 million. $1 million was worth $4 million, and now that $4 million is generating $400,000 a year of tax-free income for those people. Folks, most Americans didn't achieve anywhere close to that because they had their money in the market. So if you want to create predictable rates of return, have safety, and have zero be your hero, use the indexing options that are allowed and afforded with a properly structured indexed universal life insurance policy. If this is intriguing you, I would recommend you read my most recent book, The Laser Fund. I'll buy the book and gift it to you for free. Just go to laserfund.com, pay $5.95 shipping and handling, and I want to fire out a copy of this book so that you can learn more about how you can do exactly what I've been explaining here.